Hi everyone, welcome back to Listen. This episode is called Accounting for Managers. It's all about understanding the numbers that drive business decisions. What we're going to do is go through the accounting concepts, but we're also going to cover the language of financial decision makers in English. Accounting is not about memorizing formulas. It's about seeing reality clearly, avoiding costly mistakes, and making decisions with confidence instead of guesswork. Decisions made without sufficient information. Guesswork. As usual, I'm going to explain the phrasal verbs, the terms, the key vocabulary, the sayings. So stay with me until the end. Numbers don't lie, but they do need to be interpreted. They do need to be explained and understood. Okay, to start, accounting is the system used to record and classify and summarize financial information. Managers use accounting to answer questions like, are we making money? Where is our cash going? Can we afford to expand? Is this decision financially sound? That's an adjective. It means reasonable and safe, sound. Accounting helps managers see the financial health of an organization, the economic condition, the financial health of a company. So one of the core ideas here is that accounting is a tool. It's not a goal. Managers are not accountants, but they must understand accounting, because accounting is a decision-making tool. It's not just a reporting system. When we say decision-making, we mean the process of choosing between alternatives. By reporting, we mean presenting information formally. Managers who ignore accounting often lose control of the business. This is an idiom. They fail to manage effectively. They lose control of the business. There are three big financial statements, and managers rely on what we call the three core financial statements. First is the income statement. The income statement, this shows performance over a period of time. The question it answers is, did the company make a profit or a loss during this time? We have key elements in this statement. You'll see revenue. This is money earned from sales. You'll see the word expenses. These are costs incurred, costs that we have or we need to pay to operate. Net profit, this is what remains after expenses are subtracted, after expenses are taken away. So this statement, the income statement, it helps managers evaluate performance. By evaluate, we mean assess. Assess results, evaluate performance. The second of these three statements, these three core financial statements, is the balance sheet. The balance sheet shows the company's financial position at a specific moment in time. It's based on a simple equation: assets equal liabilities plus equity. Let me define these terms, these words. Assets are what the company owns. Liability are what the company owes. And equity, this is the owner's financial interest. So this statement, the balance sheet, this statement helps managers understand financial stability, which really is the ability to meet obligations, financial stability. And the third of these statements is the cash flow statement. The cash flow statement tracks actual cash movements. It's critical because profit does not always mean cash. It's sort of a key accounting truth. Profit doesn't always mean cash. So this cash flow statement shows the operating cash flow, the investing cash flow, and the financing cash flow. And managers, well, they use this statement to avoid what we call liquidity problems. This is the inability to pay short-term obligations, liquidity problems. Managers need to understand costs very clearly. They need to understand where the money goes. We have fixed costs. These don't change with production volume, like your rent, a company's rent on a building. This is a fixed cost. It doesn't change with production volume. We have variable costs. These do change. They change as production increases or decreases. An example of a variable cost would be raw materials. They change as production increases or decreases. So understanding these costs helps managers set prices, control expenses, and improve efficiency, which is basically just doing more with less. Managers who misjudge these costs, they often run into trouble. That's an idiom. It means to encounter serious problems, to run into trouble. I want to talk about something called the break-even point here. This is when businesses start to win. The break-even point is where total revenue equals total costs. So at this point, at the break-even point, there's no profit and there's no loss. But after the break-even point, every additional sale contributes, increases profit, contributes to profit. And this concept, this break-even point, this helps managers evaluate risk, plan production, and decide whether a project is viable. Viable is an adjective. This means capable of succeeding. If something is not viable, it's just not going to work. You'll hear about viability studies and things like this, but viable just means whether a project is capable of succeeding. Now we have two main types of accounting. We have managerial accounting and we have financial accounting. They're very different. Financial accounting is used for external users, like investors, regulators. It focuses on accuracy and compliance. Compliance just means following rules. You comply with rules. Managerial accounting. This is used for internal decision-making, like planning and control. So, managerial accounting focuses on relevance and usefulness. This is practical value, usefulness. Managers rely heavily on managerial accounting to guide strategy. Then we need to talk about budgets and control. A budget is just a financial plan for the future. Budgets help managers allocate resources, set targets, monitor performance. So comparing actual results with the budget allows managers to identify what we call deviations. These are differences from the plan, deviations, and take corrective action. That's what you're doing. You're identifying deviations from the budget. So as a final reflection or summary, accounting turns intuition into evidence. This is proof based on data, evidence. Managers who understand accounting, they make smarter decisions, they detect problems early, and they communicate clearly with finance teams. When you learn accounting in English, you gain precision, credibility, and authority in professional environments. Some of the key language from this episode with explanations, phrasal verbs we use: lose control. This is to fail to manage a situation effectively. To run into trouble. This is to encounter serious problems unexpectedly. Idioms in this subject. You'll hear guesswork. The word guesswork. Guesswork is just decisions made without solid information. People will say things like, numbers don't lie. This means data reflects reality, even if it's uncomfortable. Even if the data is not favorable. Numbers don't lie. Some of the key vocabulary in this subject. Accounting is just the system for recording and analyzing financial information. Revenue is the money earned from business activities. Expenses are costs required to operate the business. Net profit is revenue minus expenses. Assets. These are just resources owned by a company. And liabilities are debts or obligations. Equity. You'll hear this word a lot. This is just the owner's share of the business, the equity. Cash flow is the movement of money in and out of a company. Fixed costs, costs that do not change with production. So variable costs are costs that do change with production levels. Your break-even point is the level where total revenue equals total costs. There's no profit, no loss at this point. It's break-even. Budget? That's just a financial plan for a future period. So managerial accounting is the accounting used for internal decision-making. And that's everything for this episode. Thank you for listening. This is Listen. Please share, subscribe, and I'll see you in the next episode. Until then, bye-bye for now.